Hello everybody and welcome to UK Value Investor. My name is John Kingham and today I thought it would be good to talk about the S&P 500 and why its CAPE ratio says the US index is in an epic bubble. Okay, so what are we going to look at today? Four things. First of all, why I think CAPE is a good valuation tool. Then we'll have a quick look at how the S&P 500 has performed since 2009. Spoiler, it's up by about 500%. Then we're going to look at where CAPE is relative to its historic norms and what that means for potential future returns. But first of all, the usual disclaimer, which is that your capital is at risk when you invest. This video is for informational and educational purposes only. Nothing in this video is financial advice, and you should do your own research or talk to a qualified financial advisor before making investment decisions. Okay, so why is CAPE a good valuation tool? Well, it's basically a PE ratio, price to earnings, and with a price to earnings ratio, you're effectively trying to compare price to value. So earnings is a proxy for the intrinsic value of an investment. However, with the standard PE ratio, we compare price to last year's earnings, and last year's earnings can be really volatile. They can go up a lot, they can be negative, and so they're not necessarily that closely related to an investment's intrinsic value. So if we cyclically adjusted earnings just means that we take the inflation adjusted 10-year average. And so by averaging earnings over 10 years, we get a much more stable earnings number to compare price to. And therefore, CAPE tends to be a much more stable and useful measure of value than the standard PE ratio. And because of that, CAPE also tends to be a much better predictor of future returns. So here's a quick chart. This shows the S&P 500's earnings from about the mid-80s until today. And as you can see, they go up and to the right because of inflation and economic growth. And but they also wiggle around a lot. So they fell quite a bit in the early 90s because there was a recession. Then there was another recession just after 2000. Then there was another recession around 2010. And now there's another recession in 2020. So there's this kind of pattern, which isn't really a pattern, but, you know, it's there anyway, which is that about every 10 years we get a recession. So earnings jump around a bit, which means that they don't necessarily reflect the long-term intrinsic value of the S&P 500. So if instead we look at cyclically adjusted earnings, where we look at a 10-year average, then over the same period, we end up with a much more stable number, which is gives us a much more stable proxy for value, and therefore a much better tool for doing valuations with. So on to the S&P 500 and how it's performed since 2009. Okay, so in the 2009 crash, the S&P 500 fell below 700. And then in the years after that, up to just before the pandemic, it grew by 400%, taking it to about 3,400. And a 400% gain in 10 years is not normal. Then we had the crash in early 2020 and the rebound. And since the crash, since before the crash, the S&P 500 is now up 25%. So despite the fact that we are in the middle of a pandemic, the S&P 500 is now up 25% in about a year compared to where it was before this massive global crisis. So the S&P 500 is now at 4,200 or thereabouts, which is up 500% from 12 years ago. That sort of performance is not normal and it's not sustainable. Why is it not sustainable? Because the price of the index has gone up 500% whilst its earnings have only gone up by about 80%. And if price goes up faster than earnings, you're effectively getting less and less earnings for your money, which means that your expected future returns must be lower because you're getting less earnings for the money that you're paying out. There we go. So, where is CAPE relative to its historic norms? Well, the S&P 500 CAPE has averaged about 24 over the last 30 odd years. However, in the big scheme of things, 30 years isn't really very long, so it would be nice if we could look at the average over a longer period. And we can, thanks to Professor Robert Schiller's data, where we can see that CAPE has averaged about 18 over 100 years. For some more context, over the last 30 years, CAPE has ranged from about 11 to 43, which is roughly half to double the average. So today, with the S&P 500 around 4,200, its CAPE ratio is 37. 37 is about double the 100-year average of 18, and it's still 50% above the 30-year average of 24. So whether you look at the 100-year average, whether you look at the 30-year average, CAPE is way, way above average. In fact, the only time CAPE has been higher than it is today was during a brief period at the very peak of the dot-com bubble. So this is what that looks like in pictures. We have a chart of the S&P 500 CAPE ratio over the last 100 years. The red line is the average over that period, which has been roughly stable around 15, 16, although it's kind of crept up a bit in recent years because CAPE has, the S&P 500 CAPE has been quite high over the last 20, 30 years or so. However, on a historical basis, it's been a really bad idea to be invested at very high CAPE levels. So, for example, in 1929, CAPE was above 30, and returns after that were terrible. Although the Great Depression and World War II didn't help, but the very high valuations were a big part of that story. And the same thing from the mid-60s, the market was really high, CAPE was really high in the mid-60s, and then there was a long period of lots of inflation, weak economic growth, and valuation mean reversion, so that there was an enormous downward move in CAPE into the early 80s. And at that point, the market was extremely low relative to, CAPE was very low relative to its average. Then we had a huge boom up to the dot-com bubble, from which returns again were terrible. And now we've had another massive boom, from which returns will be, well, we're going to cover that a little bit later on. First of all, here's another way to look at the S&P 500's CAPE. So the black line is the S&P 500's price, and the rainbow reflects or represents where the S&P 500 would have been at different CAPE ratios. So, for example, the red line shows you where the S&P 500 would have been at about double its long-run average, if CAPE was at about double its long-run average. In other words, if the index was really expensive. So you can see that during the dot-com bubble, the S&P 500 went above the red line, which showed that it was really very, very expensive. On the other hand, the green lines at the bottom show you where the index would have been at very depressed valuations. And again, we can see in 2009 that the index did get down into those very low valuations. And the yellow line in the middle is kind of a proxy for fair value. It shows you where the S&P 500 would have been if it was trading at about historically normal valuation levels. And an important point here is, because the principle of mean reversion has applied over many, many, many decades and is likely to apply in the future to some extent or another, what tends to happen is that the black wiggly line weaves or goes on a bit of a random walk, but it's not entirely random, around that central yellow area. But the further the price gets from the yellow part of the rainbow, the more likely it is to revert back towards the central yellow part. So one analogy for this is that you've got a guy walking along. You've taken like an aerial view of somebody walking their dog, and the owner walks along the yellow part of the rainbow, and the dog is on an elasticated lead. The dog represents the price of the index, and so sometimes the dog is close to the owner, sometimes the dog is far away from the owner, but the further away the dog gets from the owner, the more and more the elasticated lead pulls, and eventually it pulls the dog back towards the owner. And at the minute, because CAPE is so high, in fact poking out above the top of the rainbow, that represents effectively the lead between fair value and the price is very stretched at the minute. So there's will at some point the force of mean reversion may override the dog's optimism or desire to pull away from the owner, if that makes any sense. So what does all that mean for potential future returns? Okay, let's just make some simple assumptions. First of all, that inflation stays close to the Fed's 2% target. Whether it will or not, I have no idea, but that is a conservative and a reasonable assumption. We also assume that earnings grow at their average rate of about 4% above inflation. So if we take those two assumptions and we project them out 10 years, we can then build some scenarios of where the market might be at various levels of investor optimism. So for example, if 2031 is a bubble and CAPE is about double the long run average, so CAPE is 36, then the S&P 500 would be at 7,200 10 years from now, which is about 70% higher. So that's a reasonable result. 70% over 10 years, that's pretty good. It's not 500%, but 500% in 10 years is not normal. So if we have the S&P 500 at a benign valuation level in 2031, so let's say CAPE is 18, you might say 20, 22, doesn't really make that much difference. Let's say CAPE is 18 and the S&P 500 would then be at 3,600, which is 15% lower than it is today. So if, from a historical basis, if valuations are about average 10 years from now, then the S&P 500 is likely to be broadly flat, maybe down a bit. However, if valuations are at very depressed levels in 2031, let's say there's something like, perhaps a global pandemic, then we might reasonably expect valuations to be very low, as they were in 2009. So if CAPE was about half its long run average, so CAPE is 9, then the S&P 500 would be at 1,800, which is 60% lower than it is today. So on that basis, there is some chance that the S&P 500 will grow sustainably over the next 10 years. But it's much more likely to stay broadly flat or even decline a little, although that's the end result. What it does between now and then is anybody's guess. And there's a small chance that the S&P 500 could be down by more than 50% by 2031. There we go. So let's briefly review that. The S&P 500 does seem to be in an epic bubble according to its CAPE ratio. So first of all, CAPE is a stable valuation tool and it's a reasonably good predictor of future returns, or at least it has been over the last 100 years. The S&P 500 has grown by about 500% over the last 12 years, and that is unusual, not normal, and not sustainable. CAPE today is 37, which is higher than at any other time than the dot-com bubble. From a historical perspective, it does look as if the S&P 500 is in an epic bubble. There's a small chance that it will be higher in 2031, that the S&P 500 will be higher in 2031, but it's more likely to stay broadly flat. And there's a small chance that it could be down by more than 50% in 2031 if the economy and investors are depressed. So that's all from me for today. If you liked the video, then please hit the like button and I will see you next time. Goodbye.